Welcome to the deep dive. We're here to cut through the noise and really get to the core of things that matter. Today, we're taking a plunge into something that, well, touches almost everyone. Car loans. They seem pretty straightforward, right? A tool to get us moving, get to work, school, just live. But are they actually helping us move forward financially? Or are they maybe trapping us in what we're calling reverse debt?
It's a really critical question.
Yeah.
Because this seemingly mundane thing, the scale is just massive. As of this year, 2025, we're looking at over $1.6 trillion in U.S. auto loan debt.
Wow, trillion.
Yeah, trillion with a T. I mean, put it this way. That's more than the GDP of most entire countries.
Okay, that definitely puts it in perspective. It's huge.
It really shows you how tangled up car loans are in our whole economy.
So that number alone should make you sit up and listen. Our mission for this deep dive, then, is to unpack all of it, the history, which is kind of surprising, the nuts and bolts, the common ways people get tripped up.
And the smart ways around it.
Exactly, the smart strategies. We want you walking away from this feeling empowered, ready to make choices that actually, help your financial future.
Precisely. The goal is to give you the insights to navigate this, because often you have to have a car. But you don't want to fall into a debt trap that sticks around for years and years.
Right. Okay, so let's rewind a bit. How did cars get so central? Post-World War II, owning a car wasn't just transport, was it?
No, not at all. It became this huge symbol, part of the American dream. Freedom, getting ahead, prosperity. It was all wrapped up in having a car in the driveway.
But while that dream stuck around, buying the actual car, that's changed a lot.
Oh, dramatically. Just look at the average price over the last, say, 30 years. It's absolutely skyrocketed.
Yeah, it's not just a few paychecks anymore.
Not even close.
Yeah.
We're talking about a major financial commitment now. Sometimes feels like buying a small house, almost.
Okay, so prices go way up, the dream is still there. How do people manage? Well, something else started stretching. The loan term itself.
Exactly. Historically, 36 months, 3 years, that was pretty standard for a car loan.
Right, I remember that being the norm.
Now, it's a totally routine to see 72 months, 6 years, or even 84 months, 7 years.
7 years for a car loan, wow. I wonder, have you listening noticed this? Maybe the last time you were shopping, were you offered one of those super long terms?
And that long term, it fundamentally changes things. It makes the monthly payment look smaller, more affordable.
Right, the illusion of affordability.
Yeah, but the total cost, the interest you pay over 7 years, it can be devastatingly high.
So let's get into the mechanics. How do these loans actually work, and why do they seem to, well, cause so much trouble sometimes?
Okay, so at its heart, a car loan is pretty simple. It's an installment loan.
Meaning you borrow a fixed chunk of money.
Right, a fixed amount. And you pay it back in these set monthly payments, principal plus interest, over a fixed period. It's not like a credit card where the balance goes up and down.
Okay, straightforward enough. But the
Yeah.
interest part,
Mm-hmm.
that's where it gets complicated.
Yeah, that's where the big differences come in. Interest rates on car loans, they can be all over the map. You might get like 3% if you have stellar credit.
Which is great.
Fantastic. But on the other end, you could be looking at 20%, maybe even higher, if your credit score is less than perfect.
20%, that's huge.
It is. And here's something people often miss. Even a small difference in your credit score matters a lot. Just improving your score by, say, 50 points. That could literally save you thousands of dollars in interest over the life of that loan.
Thousands. That really underlines why prepping your credit before you shop is so important.
Absolutely. But even if you snag a decent rate, there's another financial force working against you.
Ah, the D word, depreciation.
Exactly. Cars lose value. Fast. Like really fast. Most cars will drop about 20% in value in the very first year.
20%, just driving it off a lot, basically.
Pretty much. And meanwhile, you're still making payments based on the full original price you paid.
Okay, that's the trap. That's the aha moment, right? Your debt stays high while the thing you bought is suddenly worth way less.
Yes. That's how you end up underwater or in negative equity. You owe more than the car is actually worth on the open market.
And that mismatch, that's where the debt cycle really kicks in.
It's a primary driver. Because what happens when you want a new car, but you're still underwater on the old one?
Uh-oh. You trade it in, but you still owe money.
Precisely. And that leftover debt, that negative equity, it often gets rolled over and just added onto the loan for your new car.
Oh, man. So you're starting the new loan already behind, paying for the ghost of the old car.
You got it. It's like this invisible trailer hitch of debt you're dragging along. Have you seen this snowball effect happen?
All the time. It can feel almost impossible for people to dig out once they're in that cycle.
And think about the total cost then. This is why maybe a $30,000 car off the sticker.
Ends up costing way more.
Easily $50,000, sometimes even more. When you add it all up over the years, you've got dealer markups maybe, high insurance you have to carry, maybe some hidden fees slipped in.
And all that interest, especially on a long loan or if debt was rolled over.
Exactly. The true cost can be genuinely shocking when you lay it all out.
But we have to acknowledge for a lot of people, this isn't about buying some fancy luxury item.
Not at all.
It's about basic survival, right? I mean, think about public transport in the U.S. outside of a few big cities.
It's incredibly limited,
But
especially if you live in a rural area or even many suburbs.
yeah, for huge numbers of Americans, a car isn't a choice. It's a flat-out necessity.
It really is. Getting to work, taking your kids to school, doctor's appointments, groceries, just basic life stuff often requires a car.
So understanding that context is important. People take on this debt often because they feel they have to.
It's not always about wanting the newest thing. It's about needing a thing that works.
Okay, so given all of the high costs, the debt traps, but also the necessity, what can you, the listener, do? What are the smart moves?
All right, strategy time. First, and we kind of touched on this, but it's crucial, work on your credit score before you even think about applying for a loan.
That 50-point difference saving thousands.
Exactly. It's maybe the single biggest thing you can do to lower your long-term cost. Get that score up first.
Okay, good starting point. What else?
Second, seriously consider used over new. Let someone else take that initial big depreciation hit.
Right, that 20% in the first year.
Yeah. A car that's maybe 2 years old, it could easily be 30% cheaper than the brand new version.
And it might still have some warranty left.
Often, yeah. A
Right.
good chunk of the original manufacturer's warranty might still be active. You get reliability without that peak price tag.
Makes sense. Avoid the biggest value drop. Okay, third.
When you do get the loan, structure it wisely. Number one, down payment. Aim for at least 10%, ideally 20%, up front if you possibly can.
Why is that so important?
It does two things. It lowers the total amount you borrow, obviously, so less interest paid overall, and creates instant equity. It helps you stay ahead of that depreciation curve, making it less likely you'll end up underwater.
Okay, builds a buffer. Good. And loan terms.
Keep them short. This is a big one. We strongly, strongly advise keeping the loan term under 60 months, if at all possible. 5 years max.
Even if the 72 or 84-month option has a lower monthly payment.
Especially then, that lower payment is tempting, but you'll pay so much more in interest over the long haul. Plus, you're locked into that debt for much longer, possibly longer than you even own the car.
Yeah.
Stay under 60 months.
Got it. Shorten the timeline, reduce the total interest cost. What else?
Finally, a bit more philosophical maybe, but practice mindful consumption. Really pause and ask yourself, what do I need versus what do I want?
Like, do I need the top-tier trim with the sunroof and fancy wheels?
Exactly. Or do you just need a reliable, safe vehicle that gets you from A to B efficiently? Be honest with yourself. Getting caught up in the bells and whistles is easy at the dealership.
Oh, yeah. They're good at selling the sizzle.
They are. But making that distinction between needs and wants can literally save you tens of thousands of dollars over your driving life.
Okay, so let's kind of bring this all together. Car loans. They aren't inherently evil, are they?
No, not inherently. They're a tool,
Yeah.
a necessary tool for many people in our society and economy.
But making uninformed choices, not understanding how depreciation works, getting pushed into super long loans, that's what can lock you into years, maybe even decades, of debt you didn't need to take on.
That's the core message.
Right.
Look, being car dependent, that might be unavoidable for many of us in America. Geography dictates that sometimes.
Right.
But being debt dependent because of that car, that doesn't have to be the case. Your choices here really matter.
Well said. Your choices can make the difference. And that leads us to, I guess, our final thought for you to chew on after this deep dive. Given how absolutely central cars are to our lives, our work, our routines, how might financing that vehicle smartly impact more than just your bank account? How could it affect your overall financial freedom, your stress levels, maybe even the future opportunities you can pursue? Think about that connection.